Intangible assets such as reputation, quality, brand equity, safety, culture, and human resource are not financial explicitly, but they have financial consequences on the long-term viability and corporate performance. Global surveys indicate that these extra financials make up to 66% of the market value of the listed companies. So the need of the hour is that the leaders ought to strive for not only doing well in business, but doing business well. And ESG, an acronym for environmental, social, and governance related parameters, has emerged as an important framework to assess how companies are interacting with their stakeholders and with society in general. Evolving from global reporting initiatives, the United Nations Global Compact, principles of responsible investing, and United Nations Environment Program, ESG captures extra financial disclosures, enabling the investors to assess the value of a corporation by identifying its long-term sustainability and also any intangible risks. However, key questions remain. Is ESG metrics more of a show of numbers, or would they add value in transitioning towards sustainability? How do organizations, and particularly boards, embrace an ESG agenda? Are there regulatory or investor-led tailwinds that are promoting focus on ESG? In order to deliberate on these issues and more, in this panel discussion titled Moving ESG from five-star conferences to boardrooms, we have eminent panelists who have worked on catalyzing ESG-related changes within the country and beyond, have contributed to key documentation related to ESG, and have set up India's first ESG rating company. This panel discussion is presented to you by Center for Social Infrastructure, CSI, in collaboration with Legasis Services Private Limited, a legal support services provider, including IT-enabled legal support. Let me start by acknowledging the help and support of Mr. Suhas Tuljapurkar, the founder and managing partner of Legasis Partners and the founder and the non-executive director of Legasis Services Private Limited. Sir is a member of Technical Advisory Committee on National Financing Reporting Authority. Suhasji is a practicing lawyer with over 37 years of experience. He's one of the leading lawyers of India in the field of IPR, corporate governance, compliance, ethics, and legal strategies. He's renowned for his application of game theory to litigation strategies. Suhasji is a rare blend of consolidating intellectual properties through patents, trademarks, and other IPRs. Under his leadership, the Legasis IP team files almost 500 plus patent applications every year across 44 countries and supports over 1,600 companies to comply with all Indian laws. Recently, no wonder he has been recognized at a global forum as the Compliance Man of India. Sir has been involved in some of the landmark cases experienced by the corporate India, and he works extensively in grace, governance, risk assurance, compliance, and ethics. At Legasis, Suhasji has been instrumental in developing various IT-enabled legal support solutions such as Legatrix, Starboards, LIPs, The Flute, and Legroom, just to name a few. Warm welcome to you, Mr. Suhas Tuljapurkar. It is a pleasure to have you as our speaker and moderator.
Thank you very much. It's a privilege.
I am honored to introduce Dr. Prasad Modak, Executive President, Environmental Management Center, LLP, and Director, eConnect Knowledge Foundation, also an ex-professor at Indian Institute of Technology, Bombay. Dr. Modak has worked with almost all key UN multilateral and bilateral developmental institutions and intergovernmental organizations in the world. Apart from Government of India and various state governments, this advice is sought by governments of Bangladesh, Egypt, Indonesia, Mauritius, Thailand, and Vietnam. He's been a member of Indian Resources Panel at Ministry of Environment, Forest and Climate Change, a member of Task Force on Sustainable Public Procurement at the Ministry of Finance. Dr. Modak has drafted report on the status of resource efficiency and recommendations towards circular economy for NITI Aayog. He's also been the contributor to UNEP's Green Economy Report and a co-author of the Global Waste Management Outlook and chief editor of Asia Waste Management Outlook for United Nations Environment. Dr. Modak has served as a consultant to World Bank, ADB, National Development Bank, and AIIB on updation of environmental and social safeguards and the country safeguard systems. He developed environmental and social management systems for several financing institutions across the world that include IDCOL in Bangladesh, CIMB in Malaysia, National Bank of Egypt, etc., for several funds and financing institutions in India. A warm welcome to you, Dr. Modak. It's a pleasure and a privilege to have you as a panelist. Our next panelist is Dr. Mukund Rajan, the chairman of ECube Investment Advisor, a platform created in 2019 to catalyze ESG-related changes in corporate India. Prior to this, Dr. Rajan has held a number of senior executive positions through his 23-year career with Tata Group, including the first brand custodian of the Tata Group, Chief Ethics Officer, Chair of the Tata Global Sustainability Council, and member of Group Executive Council at Tata Sons. He served on the board of various Tata companies, including Tata Teleservices, Tata Communications, Tata Sia Airlines, and Tata AIG. Dr. Rajan serves as the chairperson of Environment Committee of Federation of Indian Chambers of Commerce and Industry, FICCI, and is a member of the Council of Management of the Forum of Free Enterprise. Dr. Rajan graduated from BTech program at Indian Institute of Technology, Delhi. He completed his master's and doctorate in international relations on a Rhodes Scholarship at Oxford University, and his doctoral dissertation, highly acclaimed, Global Environmental Politics, was published by Oxford University in 1996. His second book, The Brand Custodian, was published by HarperCollins in 2019. Pleasure to have you here, Dr. Rajan.
Thank you so much. Thanks for having me.
Our last panelist, but not the least, is Mr. Shankar Chakraborty. Mr. Chakraborty is Group CEO and Executive Director at Acuité Ratings and Research Limited. Mr. Shankar is leading Acuité's transformation from a full-service credit rating agency to a technology and innovation-driven knowledge company. He has 2.5 decades of experience in developing and selling data analytics, risk management, credit ratings, and financial research solutions. Mr. Chakraborty was an independent director on the board of Indian Oil Corporation. He's been a member of the working group constituted by Insolvency and Bankruptcy Board of India for recommending the provisions of the Insolvency and Bankruptcy Code. He's a member of FICCI's Capital Markets Company and Executive Committee of Maharashtra State Council. He's also a member of IBA's Standing Committee on MSMEs, and he holds a master's in business management and has a bachelor's degree in physics major. With such exemplary panelists on board, I would now invite Mr. Tuljapurkar to kindly take over as a panel moderator.
Thank you very much, Diti Madam, and thanks a lot for that elaborate introduction. It just kind of trying to set that tone there. But I must say that my job is very easy as a moderator. We have such excellent speakers. Thanks a lot to Dr. Mukund Rajan. Thanks a lot to Dr. Prasad Modak and Mr. Shankar Chakraborty. You see, I'm just trying to set the tone for this discussion here today. This was yesterday's report in the Abu Dhabi ESG conference, where what came out after a survey of almost about 525 global executives is that 87% of the respondents said ESG performance is now the core strategy of their business. 50% of them said net zero emission is our target. 85% said pandemic has been the wake-up call for all of us when we talk about ESG. 63% of the respondents said that after the pandemic, ESG is probably our priority, which is shift to priority number one at the board level. You see, also almost everybody understood that ESG would pay off in probably short period of time or medium term that we look at. So it's no longer that it's only long term payoff for the ESG, and ESG is today becoming actually the tipping point at the board level. So I'm also saying that if we're not getting into, and this panel would probably not discuss about what constitutes ESG, what is sustainability, what is SDG, what is SRI, which is the sustainability and responsible investment. We will not talk about what is business responsibility reporting in India and how does ESG translate into that. What we are going to look at is how part of these elements, because it is an imperative now that the ESG is beyond the tipping point, at the center of the agenda for almost all board of directors today. When I think during the pandemic, it so happened that the profitabilities of the companies were stressed and everybody's results were adversely affected. Almost everybody's results were adversely affected. I correct myself there, because some of those essential companies and which continued to be in the businesses, their results have shown improvement. But I think by and large, overall stress was demonstrated everywhere. And therefore, the company's performance on parameters beyond profit, which is the ESG, came to the forefront discussions. It is in that backdrop. And of course, I'm not going to miss out on the backdrop in India, which is the compliance being pushed there. In 2009, we had NVG guidelines that came in, which became optionally reportable in 2011, adopted by MCA. In 2012, SEBI said top 100 listed companies need to now talk about BRR. Business responsibility report became mandatory for 100 companies. In 2015, 100 became 500 companies. In 2019, the guidelines were revised, NVG guidelines were revised, and BRR became mandatory for top 1,000 listed companies. You come to 2021, two things have happened. I think one, of course, the CSR part has become mandatory out of the CSR rules that have come up. But business responsibility statement, which was there, has now been converted to business responsibility and sustainable reporting. So BRR has become BR and SR. So that's the journey here. But we're not, again, I said, we're not getting into the details in terms of looking at the legalese there. We also, there is no discussion any longer that ESG is fashion or fraud. Its reporting is mandatory. And we're going to look at how part of this ESG, and that's where I'm going to start off with Dr. Mukund Rajan to understand as to, in his experience and after now having set up $1 billion fund, as to how are companies kind of embracing, embedding ESG today. Dr. Rajan?
Thank you, Suhas. So I think my starting point would be that you quite rightly said the awareness is now substantially increased. But I would still argue that in the Indian market particularly, while there is perhaps much greater understanding than used to exist earlier, there is not necessarily as much action on the grounds as yet. So many people will pay lip service and certainly espouse the importance of ESG in their company strategy and business. But when you dig a little deeper, you find that not only actions not forthcoming, even the reportage is relatively scanty. We undertook a study of till last year when you had the top 500 listed companies required to produce the BRRs. Even the existing business responsibility report framework I think a lot of the disclosures that were required to be made, many companies were actually falling short on providing truthful, accurate, and exhaustive accounts of what they're actually doing. I think we'll have to see how much attention they now pay to the BRSR. And I think the good thing that could happen going forward, two things. One is the framework has become a bit more explicit, and therefore you'll have many more stakeholders actually putting pressure on companies and businesses to really make better and more transparent disclosures. There will be league tables, naming and shaming, all of that will take place. And perhaps down the line, SEBI, which has mandated this, may also consider some provisions to actually turn the screws on companies at default on providing truthful and accurate disclosure. So that, I think, will be a very important development as and when it takes place. So one is hopeful that things will improve in the future. I think two things in the recent past that have really been critical drivers for businesses to take all of this more seriously. One is the significant concerns around corporate governance. I think it has been perhaps the single biggest reason for some of the ailing of the banking system and some of the economic implications of that. The large amount of NPAs in the banking system has built up, has been part of the reason for the economic slowdown even before COVID happened. The second is the increasing concern around climate change. I think India will not only be one of the largest contributors to climate change, we are already the third largest greenhouse gas producer in the world, but we will also be one of the largest victims. And already you're seeing some of the implications of that for Indian farming, for people living on the coastline, for issues around extreme climatic events, the risks associated with all of that. So I think businesses are also understanding that they can get significantly impacted by this. I think that's pushing them to become a bit more serious about the way in which they take on board some of these issues. And I think as you get better frameworks for disclosure, better frameworks for analysis, and now you have stewardship codes that bind some of the largest investors, institutional investors in the stock markets, the insurance companies, the mutual funds, pension funds. I think the pressure on corporates to do right and to do well by the stakeholders is increasing. So my sense is we are not there yet. It is going to be an evolution. It will take us a few more years to start seeing the majority of even the top 1,000 listed companies being much more compliant and dealing with some of these new expectations. But slowly we will get there.
No, thank you very much. Thank you very much for that articulation, and hope that we will get there. You see, I'm going to move to Dr. Modak, and sir, I think I'm just going to state only one experience that I have had. When the top 500 listed entities, it became mandatory to do the BRR, they thought it is good to get a lawyer on the board who can write a report. Probably in the legal is to look at NVG guidelines, because MCA had mandated NVG guidelines. So it so happened that when I started talking to a large listed company, you see what happened is they gave me a bunch of photographs. And they said, these are the activities that we have conducted in past financial year. Why don't you look at these photographs and prepare this report for yourself? I said, fine, let me try and make that attempt, because I have to earn a livelihood out of this. So when I started looking at the photographs, and there was a promoter's family standing there in a pet show, the Dog Carnival of India, and promoter's family was there. That was one of the photographs given to me. Another photograph that was given to me was actually a retirement send-off given to the driver of the company who was working there for 35 years. Sir, I think, we prepared a report. We went back and forth and we did some kind of a thing, because it was comply or explain regime. And therefore, I think we said, fine, disclosures in whatever form manner, you do it right now, but at least start the journey. And as I think Dr. Rajan said, I think we are hopeful that we've started the journey. We'll go to the next level there. But how critical and important, and has anything changed now that we are looking at? Are the companies coming forward to say that we want to take this seriously? We want to make sure that now we have action that will be reported, rather than report being prepared on whatever we have done. What's your experience, Dr. Modak? You're on mute, sir.
No, I was just saying I'm with you, what you just narrated, your experience. But let me build on what Mukund just talked about, in terms of Like he rightly said, that we're just beginning towards this transition of putting ESG as a part of the business agenda. And we have a long way to go for sure. But if I traced back the history, the way disclosures on environmental social count scheme, they go back as early as in 1990s in Indonesia, where the government of Indonesia came up with a scheme called Proper. And it was a regulator-driven disclosure asking. And they had their own color-coded scheme. It was taking basically the industries to understand that going beyond compliance, it's a good thing to do. And they started putting these color codes next to the results of everyday's share market. And the idea was that this disclosure on environmental social counts and the financial position of the company, so to say, from the market, how does it go together and will it change the mindset of the investors when they look at how good or bad are they on the environmental social counts? So regulatory driven disclosures, if you look at it, Suhas, from that point of view, you can imagine that we were to make use of the BRR, or now we have BRSR, and draw our ESG indicators, which are fairly linked to what we ask in the reports, and use that construct as a very basic ESG index and bring it out, get it through the stock markets who are signed up either or not for the sustainable stock exchanges, but have that mainstream. I think that could be very interesting, where the market and the regulator comes together. And I think that kind of a blend is interesting. The other challenge what we faced, which was echoed a bit, I think, Mukund, you talked about that. The whole data completeness and veracity is a big deal. And that happens because there is no today universal ESG rating system. Although you do see World Economic Forum coming up a few months back on a 22 indicator based ESG rating. But then, there is MCSI would rate, for example. That is another issue when we want to bring it to the practice level. What is the kind of a rating scheme am I using to guide? But I think more importantly, what has happened, it has become a bit of a mechanistic exercise. And to me, most of the ESG analysts I meet are not materially understanding environmental and social issues. Either they are not trained on that, so they are basically excellent Microsoft Excel appliers. And that depth of interpreting the numbers to guide the business how to strategize, leveraging on sustainability is simply missing. Unless today the business here realizes that going through this exercise is a structured process to figure out not just sustainability, but address resource security and resilience, business resilience. I'm taking one step more than sustainability itself. I think that would be a driver for the business to move from general discussions to actions. And you need some demonstrations for that. If you remember, ESG linked performances and financial performances, there's been a huge debate. We have seen equal number of research outputs. We say they are linked and some say they are not linked. We have funds, Mukund, you are involved, ESG driven funds. We have several of them. But I think even understanding that part little more in granularity so that the business gets and the appetite to move towards ESG. I think that will take a while. As Mukund, you rightly said, it's not going to be overnightly transformational. And I guess most of our responses are reactionary coming from international investors. And that has again messed up because that pressure which has come up to respond to that pressure somehow, that somehow part is the challenge, I would say. So maybe I will come in a little later, Suhas, but that's what I feel, what you just mentioned, we should be tackling.
No, sure. I think I'm going to request Mr. Shankar Chakraborty, because see, what has happened is when Mukund talked about data, I think, Dr. Mukund Rajan talked about data, Dr. Prasad Modak talked about data. I think data is becoming critical in today's circumstances. We've also seen that when GRI regime was there, I think the data reconciliation was the biggest challenge. And I mean, as Dr. Modak tried to articulate, to say that, you need to consider the indexing, benchmarking, rating, and how important is that. You are the first rating agency on ESG in India at Acuité. And I think I would like to understand from you as to, why you thought this was essential and how it is shaping up today.
Thanks, Suhas, and hi to all my fellow panelists. I hope everyone is okay. The times are really, this is the time when you cannot really think ESG is not important. It's pretty easy to say that it is important and we need to push it. So let me tell you a little story, in a few words, how we came here. About 4 years back, a series of credit failures started happening in India. And as being part of a credit rating industry, we were extremely concerned about the credit failures, which in most cases was sudden and quite disruptive. So we went deep into these each individual case studies. And as we know that quite a few rating agencies have burnt their fingers in predicting these events. So we figured out that governance is the single most important factor. And ignoring the governance aspects of a company could lead to not understanding credit risk. Similarly, we looked at a few other incidents, and we saw that the companies taking environmental and social risks are significantly at a risk for credit failure in the long term. So once that got established, we started thinking, what is the right mechanism to measure risk and inform the investors and the lenders about the risk in an objective manner. That's where the process for building a methodology and a mechanism really started. But the other driving factor behind us has been the incentive structure. Now, what happens when a company wants to do ethical business? We all know we are part of India. At least in my 25-year career, I have heard this hundreds of times. People discouraging another person from starting a business, saying that सीधे रास्ते से business तो हो नहीं सकता. We felt that perception needs to change, and people need to have the right incentive structures to trade the right path while they are doing business. So while it is commonly believed in India that business requires certain breaking the norms and all kinds of stuff, we believe that it is possible to create incentive structures for companies to get cheap money, to reduce their interest rates, and to get attractive buyers to build a sustainable business, provided they can prove that they are trading the right path. Now, why a rating agency is required for that? Number one is that there is too much of data. On one end, there is no data. We all know that data is not structured, data is not standardized, and data is not entirely correct. On the other hand, data is everywhere. So if you want to search for ESG performance of a company, you practically get information from every possible source, Reuters to Bloomberg's to balance sheet to annual reports to newspaper to controversies to MCA, and there is nothing that consolidates everything at one place. Compared to this, a credit rating exercise is much more limited, and you can limit your interactions with 4 or 5 broad sources, and you can derive a credit rating in the traditional sense. So obviously, on one end, data is not there. On the other hand, there is an explosion of data. So we needed to build a completely unique methodology and a process to ingest that data, to structure their data, make it comparable, and then write the rating reports. So the data part has been the most complex part of our entire development process. We have started rating 500 companies. We are launching our subscriptions in the next month, which I will speak in the little later. But as we are speaking, 150 people are actually crunching the data, collating the data, and putting it into a common sized database. Parallelly, another team has developed a workflow, electronic workflow, to ingest that data and produce the rating reports and present it to the analysts, who then evaluate the reports and give their comments. So this is how the entire process works. Now, if we are able to do it successfully, and if the market accepts it, what changes is that a company is able to compare itself with its own peers. So companies like Indian Oil, on a standalone basis, as you have correctly suggested, that BRSR or business responsibility is limited to a few photographs, right? There is no understanding how I stand vis-a-vis the next player in my industry. There is no competition. There is a competition for more market share. There is a competition for better margin. There is a competition for more profits. But there is no competition on building a ESG compliant system which will sustainably deliver results to the company and its bottom line. So this is essentially what we are trying to do. Our role is very, very limited. We don't believe that we will be changing or bringing a revolution overnight. But if we are successful and we can create a very robust mechanism of measuring ESG performance and comparing it across the companies, it will automatically create incentives for banks to lend money to those companies who are better than the others in a cheaper manner. The banks are going to be able to predict credit failures without getting surprised suddenly, which can create a complete disruption for the bank. These are the limited contribution that we are trying to make.
No, sure. Thank you. Thanks a lot, Mr. Shankar Chakraborty. I'm going to request Dr. Mukund Rajan again, coming back to you, sir. I think, what is it that needs to be done so that at the board level today, there is a correct perspective, understanding, awareness, and embedding or seeding the ESG principles at the board level? How do we do that? Because at times I think we failed in kind of reaching out to the board in the first place. Second, even if we reach out to the board, I think the issue then seems to be, this is not the priority for us. We are fighting here for the survival at this point in time. And you're talking about ESG. You have had tremendous experience in making sure that this is seeded at various boards. So I'm just going to call upon you, how part of it, how do we do that?
So 2-3 thoughts that I'll share with you. The first, obviously, is you need some level of realization dawning within the board on the importance of this. And the good news, as we discussed a little while back, is that there is much greater awareness that is building up. There have been some critical drivers for it: pressures around corporate governance, concerns around climate change, regulatory pressures, pressures to produce better data, and so on. So board, certainly today, I think there's scarcely a board that will be there in the country which has not been exposed to some of these dynamics and understands that this is getting more important. But to get a bit more deeper and engage with the subject, and to ensure that ESG principles and the broader concept of sustainability is mainstreamed into the strategy of the company, I think you need a bit more to happen around you in the board and elsewhere in the company. I think you need to have a clear vision of where you want to take the business and how this issue actually links to that vision. A lot of people have talked about purpose-driven corporations and the fact that ESG is something that often gets adopted first by companies that are more purpose-driven than some of the other companies. And I think there is some merit in that. If you have a clear sense of who you are, what you exist for, what your company is trying to deliver in terms of value to its stakeholders, you can find a means to then integrate the broader subject of sustainability and ESG principles into the way you think about your corporate purpose. You then need to have an architecture within the company, starting from the level of the board, that actually directs your mission in a way that delivers on some of these stakeholder expectations. So minimally, you need to have a policy around sustainability. You need to have a team of people who are assessing what is most material in ESG issues for your company, your business, and advising the board on what we need to do, what kinds of targets need to be set, how we need to think about the future, what kind of risks we run if we don't do this well, and therefore how we actually build into all our planning and processes a view of the future. So you need to have that organizational support. This can come in many ways. You can have people within the management who are appointed to do this. Many companies have chief sustainability officers, for instance. Many companies have chief technology officers, part of whose remit is to look at trends in technology and how this is going to impact the future of the company and its business. So there will be people who can be nominated to actually address this and then brief the board at periodic intervals. You need to ensure that there is an alignment across the organization that all this matters and is important. It's no good the board just discussing in a closed room and then the rest of the organization is not privy to those discussions. There has to be a method through which you can actually get the entire organization aligned. Some companies do this even through their code of conduct. They make sure the code of conduct actually speaks to all the critical ESG issues. This is something that the board blesses and is then cascaded across the organization. And there is periodic training and awareness building for all stakeholders of the code of conduct. The board must monitor performance and progress. So you need to have a system where you're actually tracking on your material ESG issues, how you're doing, how the organization is energized, what kind of results you're delivering, and how that information is being spread throughout the organization. The old adage, what gets measured can get improved, is as true of ESG, including issues like ethics and corporate governance. So you need to have those mechanisms. And then you need to have, I think, a huge amount of communication. That's something that we found in Tata's on issues like ethics also. The more you speak about these issues, the more you walk people through dilemmas, the more information base you build up, the more knowledge you share, the conversations you have in town halls. All of this is very, very important. There is no limit to how much you can continuously communicate the importance of these subjects. And again, this has to be driven really from the board and then cascaded across the organization. So I think all of these are important considerations. So leadership, organization structure, communication, measurement of effectiveness. These are, I think, integral elements and components of any plan to actually embrace an ESG agenda.
No, thank you very much. Dr. Modak, I think you've been called upon umpteen number of times by the boards to engage on the ESG agenda, an environmental agenda predominantly, but now it's the ESG that's kind of coming to the forefront. Just kind of how do you want to consider or how we should be engaging the board and the how part of it is more important for me based on your experiences? Are there any anecdotal kind of incidences that you can share with us where you converted one person in the board, one member into the board on the positive side of ESG and made the difference? Anything of that kind? Or it is the one person who is not getting converted becomes problematic in moving the agenda? What is that and how do we do that?
Well, Suhas, there are many stories which I could tell about how ESG percolates when you are with in the board meeting and communicate ESG. By and large, what happens that people look at ESG as a mechanism to address the risks.
Okay.
Now, moment to turn around and look at ESG as an opportunity, not just in terms of returns, but also building the innovation capital, the whole psyche changes. And I just can't give there as statements like a preacher, but I must cite several examples where people have really gained by looking at ESG from another lens. Once you speak in that language and giving such very concrete examples, the whole atmosphere, the psyche of the board members changes. And I have seen such turnarounds where I remember initially you say that you have to have it for ensuring compliance, and you might then say going beyond compliance has an advantage in terms of risk aversion. But when you say that this mechanism of mainstreaming is adding a value, a stakeholder value, and also giving it an opportunity, what we use the word, ecological modernization of the business. Remember, it's ecological modernization of the business. That word catches. What is it? Immediately the board member will ask me, and then obviously I have certain stories to tell to the board, which of course have to be real. And then it's a breeze. I remember many board meetings, I used to go with some 30 odd slides, for example. And then I would be stopped at 15th slide when I start talking about ecological modernization. And they would then tell me, stop your presentation, let's get into action. Okay. I've witnessed such things, very positive examples. But then you need a giant mind present in the boardroom. You need that. My experiences have been not so great with CFOs, but my experience have been great with these people with giant minds who look much beyond. They can see the future. And that's the reason sometimes, Ullas, like we discussed many times, like you have a wonderful tool like Legatrix, like a compliance tracker. But I remember when we used to do environmental social due diligence, I changed the term to call that as an opportunity assessment. The whole response was different. I was then not talking to the environmental officer or a sustainability officer, but the production head. And he said, talk to me. And I want to understand how can I do better? And we did that. We did show in the business that how can I improve productivity? How can I improve access to better markets, especially export markets, by putting ESG in that lens. So we got to, Suhas, use that language. And then the boardroom will respond differently.
No, great point, sir. I think that's very important. And I think one paradigm, which is where we are saying what gets measured gets achieved. And from that perspective, I'm going to come back to you, Shankar, and in terms of understanding, is it that simple today? Because I think at one level, Dr. Modak alluded at the beginning by saying this is becoming a mechanical exercise, which it ought not to. In a sense, it's not merely driven by Excel sheet. It's got to do with, a lot of it got to do with, as Dr. Rajan said, in terms of culture of the organization, culture of the people, the DNA of the organization on these paradigms. So how do we convert that into something where you want to benchmark, you want to rate?
Yeah, so I think the point raised by Dr. Modak and Dr. Rajan are both extremely relevant. It is very true that most of the people that you see around are Excel pushers, and they don't really have a practical understanding of how ESG affects them in day-to-day life. People, when they experience a crisis in their own family, their awareness builds up. But most people have not faced such crisis. Like, for example, what kind of, we are cutting all the mangroves in Bombay. Now, if you're where you stay, if that place is not going to get flooded, you are not going to realize what impact it costs in the medium and long term. So we have to deal with all these problems. But if there was no problems, we would not have a business, right? So everybody would have been able to do it. What we are doing is that while choosing our people, we obviously are dealing with very, very young people here. Now, most of the people of my age, they don't believe very strongly in ESG. But my hope is on the young people. If my daughter and my son, they're not my son has just started working. My daughter is very young, but their awareness of not what harms the universe is very, very sharp. Like, for example, 3 years back, I did not understand that. I'm talking about myself here. So I didn't understand that all these waste materials in the sea, how big a problem it is for the whales and all the animals in the sea. It is my daughter who came and showed me a video, and then I started realizing it is akin to living in a closed room with a lot of smoke for these animals. So these are the people who are still, their intelligence is still elastic, and they can quickly pick up, if they are already not aware, they can be quickly trained and sensitized and given this insight. But at the same time, I don't entirely deny that there has to be a method in madness. So while I don't want people to be mechanical, but I also can't say that we cannot follow a method. We have to follow a method. Now, what we have done to follow the method and make sure that the companies are able to accept this framework and understand it, and the counterparty, which is probably a buyer or a lender or an investor, can also accept and understand it. So that is our responsibility. We cannot build a system which is a black box and people will not understand. So what we have done is we have analyzed hundreds of sources of data in India and picked up 728 signals. Okay. These 728 signals are essentially, which is the universe of all ESG signals that is available, on which the information is available. These 724 signals are all not available for all companies. For some companies, there are 600 signals that are available. For some companies, there are 500 signals. But the universe is 728 signals. These 728 signals are then classified into broader groups, and eventually they fall into one of these E, S, and G categories. The other thing that we do is with the standards of disclosures, how much the company is disclosing. We actually measure that, benchmark it with the peers, and we give them a score which is called a transparency score. So when we rate a company, we arrive at 4 things. One is the environment score, social score, governance score, and the 4th is a transparency score. This transparency score is actually a driver of the fact that companies will have to disclose more and more disclosure will lead to better incentives. If a company thinks that he can achieve better rating by not disclosing, that is the safety valve for that is kept with the transparency score. So this is the combination of methods in the madness and a very refined sense of ethics is what we are trying to deal with here. I cannot say that we have really found the perfect formula for it, but given the 12 new analysts that we have trained in the last 1 year, I think I see a lot of positive feedback about the fact that we can keep hope on these people. But the companies, whoever will be analyzed, mutual fund will have to have a ESG desk. The banks will have to have their ESG desk. They cannot take a shortcut. They cannot say that, they will poach a few people from here and there, and then they will put them in the room and they will say that, now you do ESG. That is not going to happen. The companies has to commit resources in education, in studies, supplying materials to people, even give them high-end materials to read, which may be very, very expensive. So without that, I think building this mechanism is very difficult. One last thing I would like to mention is that these 728 signals that I have spoken about, each of these signals have their own characteristics. We are dealing with 728 signals and about 200 industry clusters. Now, for each of these industry clusters, the materiality or the importance of these 728 signals are very, very different. So the analyst is actually looking at sector by sector signals and giving a certain weightage or a certain materiality to each of these factors, so that we don't put everything in one thing and create a hodgepodge there. The second thing that we are doing with each of these signals is measuring the polarity of these signals. The polarity essentially means if the signal value is high, it could be good for some signals, or for some signals, if the signal value is low, it could be good for the signals. Carbon dioxide emission, if it is higher, or a methane emission, if it is higher, it is bad. But water conservation, if the signal value is higher, it is actually better. So each of these signals, materiality and polarity has been decided by the analyst to build the system. So this is the method that we are trying to bring in the whole process. And we believe that if we can build this system and people find it, we actually don't mind open sourcing. If a bank wants to use our, Dr. Modak has mentioned a very important thing that, MSCI, Sustainalytics, maybe us, maybe everybody else, they have built their own methods and their own processes. Now that's going to be a challenge maybe 10 years down the line, and maybe the most effective one will survive. But meanwhile, I am willing to give, I am willing to open source my methodology to all the banks and all the investors, whoever wants to use it. So I don't want to keep it just with myself, because more people using it is going to benefit more people.
No, that's a great gesture, and thank you very much for that. We're going to experiment for sure. We're all into this with the innovation mind. We will do that, Shankar. Believe me. I think, but I think I'm conscious of the fact that we're probably speeding towards the close of the time. But I want to do one last round in terms of one critical question that is bothering me, honestly. You see, when it comes to compliances, I think it's an oversight function for the board. When it comes to risk, it is the oversight function for the board. In a sense, I think to an extent, whether the risks are arising out of compliances or risks are arising out of ESG, they're still an oversight function for the board. Governance is probably the line item for the board, and I think board then acts as a fiduciary there, and therefore governance becomes line item for the board. You see, board definitely is a fiduciary. Like we all are a fiduciary when we talk about environment. We are kind of custodians here. The generations prior to us handed over these nature and earth to us, and we have to kind of leave it for the next generation. So we are merely custodians here. How do we utilize the resources, etc., broadly would depend on how we behave as custodians. Similarly, at the board level, when you talk about fiduciary responsibility there, I think they got to be there because there are stakeholders. And ESG is prominently today at the center of the discussion, whether you call it resilience or coming now because of the resilience and pandemic. Therefore, does ESG as an agenda become the line item responsibility of the board rather than kind of leaving it to somebody and having a mere oversight? Because that will make the shift happen. And I'm going to request Dr. Mukund Rajan on this point as his first views. We'll do the round and then I think we'll open up for question answers.
No, I think that's a great question. Honestly, I think it belongs in both domains. But let me, in a very practical way, sort of point out how some companies have tried to address this. Some companies, including the Tata Group companies like Tata Chemicals, more recently Tata Steel, have actually combined the function of the CSR committee of the board into a CSR and sustainability committee of the board, where what helps is you have independent director representation, but you have at least a focused attention on what are seen to be some of the more material issues as part of a broader ESG or sustainability thematic that this committee looks at and then reports back to the wider board, and there are discussions at the level of the board. Some companies have created advisory councils which look at this issue and then brief the board, and there's an engagement between the two. All of this presupposes that within the management, you already have an appointed location of responsibility for this. So I think it is something that has to be discussed across the board. Ideally, you should also have a board composition where there are at least one, if not more, experts, so to speak, in some of the more critical material ESG issues that a typical board in an industry in which the company is will operate. And so you have some expertise that informs a lot of the debate and discussion that takes place at the level of the board. But it would be a shame if it is relegated, to a committee or indeed down the line to a management committee. And sometimes that can happen even in the risk function. It sort of gets pushed downward and eventually out of sight of the larger board. So going back to my earlier point about linking this with the corporate purpose, linking this with the vision of the enterprise, seeing the value that stems in the long term across a host of issues from risk management, cost reduction, the circular economy, resource efficiency, you would hope and expect that the board as a whole will be seized of this and will not delegate it elsewhere.
No, thank you very much. Shankarji, would you kind of just in your rating model, how important is this that board is responsible on ESG?
Not only for ESG rating, the board, this is actually a simple issue, relatively simple issue. The board is already responsible for large part of the ESG, and there would not be any doubt that governance is board's responsibility, right? So if a company is profitable, if a company is, otherwise a well-managed company, if the company has a decent business model, if the company is not worried about, other disruptions due to demand-supply issues and stuff, they have to focus on E and S part. But irrespective of anything else, they cannot deny that governance is their responsibility. Now, the real issue is that our boards, some of the companies who provide advisory to, the proxy advisory companies who provide advisory for voting, as some of their reports will tell you that the standards of governance is really, really poor. So board, even if boards are not right away awakened on ESG, they have to at least start working on compliance, disclosure, and governance. These are the three areas. E and S is a slightly more complex issue because there are companies whose business itself is anti-environment and like for example, your oil business. You cannot change your oil business overnight and get into a solar business. It doesn't happen overnight. But in the natural course of risk management, I would like to see Indian Oil Corporation is looking at renewable energy as if they believe that they're the energy provider of the country, then they have to find better, cleaner, and more sustainable energy to feed the country with. Now that is their responsibility, but it's a bigger challenge, and there is a long-term vision that would be required for that. But what about governance? A lot of large companies, particularly in the government sector, does not have adequate number of independent directors today since last 3 or 4 months. These are the things that can be addressed and must be addressed before we can think of ESG, because we are probably the first step is the easiest step to take. So let us take that step first. That will be my.
Sure, thank you. Dr. Modak?
I think a lot has been said by both the panelists. I'll just give you something very simple experience I got with one of the corporates. This was a company with investment from companies from Japan. And this question was put to me, what you just asked. And I said, can we have a board agenda item to report on the natural capital the company holds, where they have ownership, and the natural capital that they are influencing or affecting. So as just these two agenda items
we'll get on that.
Just brought ESG in the focus.
Great,
just report on these two things. And I never forget the company chairman. We had lunch after that and he said, oh, I never thought it is apparently simple, but now that I think more, It's much more complicated. How do you define the natural capital? And, so I'm just telling you this as an anecdote, but certainly this is a way that, the board pays attention when you use the word like capital.
Okay. Thank you very much. Thanks a lot for that. I think we're quickly moving on to the questions. Am I good on time? My KRA has been modified to go up to 11:45. Okay, sir. This is a question from Urvesh Patel, and he says, "What are the best ways to control data manipulation?" I'm going to request Shankar for his views.
Sorry, can you repeat the question once again?
What are the best ways to control data manipulation?
Well, control as in an investor or in terms of the company?
I think it's just broad question about input data being manipulated.
Okay. See, basically, we at rating agencies, we have to deal with data manipulation all the time, right? So people want the best rating. Typically in India, everybody thinks that they're AAA, and anything other than AAA is very bad, right? So we have to deal with that, and along comes a lot of creative ways of presenting data. I would not say manipulation; I would use the word creative, because I'm a civilized man, is what I believe. So we have to deal with that. So we have developed benchmarks for industries, for sectors, and of all kinds. So if data comes which does not talk to each other, then our analysts should be able to catch that there is something wrong. So if somebody says that, look, my capacity utilization is 80%, and I know that the industry's capacity utilization is not more than 50% because I have the industry data, I would question him, how I would cross-verify that data, one with his peers, other people that we know from the industry, or from the company itself, challenging the company through the management meeting. Now, the more such benchmarks are available with the analyst, the more power they have in their hand to test the data and reject the notion and move forward. So this is how people have to do it. We have the advantage that we have data across all banks, clients of all banks. We obviously have a larger data set because we are rating across banks and across investors. Individual banks and mutual funds and others, they may not have that big an advantage, but they will have to develop these benchmarks so that they can question. Now, every parameter has its own standards. Like, for example, carbon dioxide emission. You cannot run a steel plant with where one company will be a complete outlier compared to its peers. So you have to use benchmarks to test the data and reject the data if necessary.
So thank you very much. Thanks for that answer. I think next question is from Mr. Digambar Deshmukh, and I'm going to request Dr. Prasad Modak for this. Do any ESG elements constitute risk premia? Is the question from Mr. Deshmukh.
Well, fundamentally, yes. Fundamentally, yes.
So, I mean, can you give a couple of examples of these elements that will constitute risk premium?
If you look at it in terms of, let's say, even getting a lawsuit because of environmental non-compliance, leading to either loss of reputation or a business interruption, that's a big premium that you get by insulating that risk arising mainly from ESG consideration.
Sure. Thank you, sir. Next question is from Mr. Robin Singhal, and I'm going to request Dr. Mukund Rajan for his answer on this. In recent times, even the governance of the rating ecosystem has come under question. To address this, should there be more industry academia collaborations to the mainstream ESG, or should we leave it to the industry, by industry for industry kind of a structure?
No, I certainly hope that there will be much greater stakeholder interaction. And I think academics have a very important role to play. The regulator has a very important role to play. And obviously businesses have to see that this is something that is relatively easy for them to, periodically disclose and make reports. What industry hates is, being thrown with, compliance after compliance requirement, each of which has a different set of groups within the company, requires oversight. Sometimes you can stumble and then you get hauled up and there are penal consequences. That industry doesn't like. I think it's in everyone's interest to try and see if you can create an efficient, universally recognized, at least in India, set of standards. And it has to be stress tested in the system. And I think all of these stakeholders have to play a role. I think the place we should all perhaps put our attention on is the business responsibility and sustainability report framework, because that is now a requirement for the top 1,000 listed companies. SEBI is taking that seriously. It already has integrated the national guidelines of responsible business conduct into it. So there is an effort to now align it with the expectations that the MCA has also put out. So I think if we can use that as the base and try and ensure that you have a set of standards that everyone subscribes to, agrees is sort of world-class, is taking India in the right direction, is easy to report against. And then you can have league tables, and as we discussed earlier, naming and shaming by non-profits, by people who do analysis, useful for investors, useful for the equity analyst group. I think that makes much more sense. And industry should welcome it, because the ones who are already doing well can stand to shine compared to the peer group. And others also know on what basis they need to improve in order to achieve the highest standards in their respective industries. So I think absolutely that is totally called for.
No, thank you very much. There are only 3 other questions left, and I'm going to quickly move on to that. Is one question to Mr. Sankar here from Dr. Raviteja Kanchrala. And Shankar, he says, how is your mechanism different from best business bureaus in the US? Can we replicate similar weighted average method based on the feedback form from different stakeholders? That's the question. The second question again to you is, please provide us the link, or where can we access that the open source data that you talked about, or model that we talked about, because I think everybody would want to connect with that.
Yeah. So the link is esgrisk.ai, esgrisk.ai. Is where you will get all the resources. We almost every day, you can also follow our LinkedIn page where we almost every day post resources. And our intent is to create a ecosystem, a cooperative ecosystem. So everybody is welcome to join, and industry, academia, people from other companies, if they want to publish anything which is of material value, we will not mind giving them our platform. So that is one part. Now, credit bureaus are a completely different business. They are not in our business. We are not in their business. Credit bureau basically a fact reporting tool, whereas what we try to do, it may sound extremely flamboyant, but what we try to do is try to see the future. So we build models, we build statistical tools to try and predict what is likely to happen in future, and credit bureaus report what has already happened in the immediate past. Now, these two things are completely different. How we are different from other rating agencies in US, if that is the question that you ask, is that we understand India. Now, what I don't want as an Indian, as an Indian businessman, is complete and sudden disruption because of ESG. I don't want all our oil companies to go burst in one day. I don't want even the tobacco companies to go out of business in one day, because trust me, some of the tobacco companies, and let me name it here, ITC, is doing a fantastic job of on the ESG front. So we don't want to create, total and sudden disruption for the system. What we want is to create an incentive structure so that normally incentive structure is missing. You want to disclose data. Is it incentivized in any way? No. That's why most companies want to remain private, right? So there has to be incentivization of good behaviors for these companies. That's what we are trying to do. And second point is that we understand India. Indian laws, India's BRSR guidelines are very different. In many countries, there is no requirement of independent directors. In Europe, there are two-tier directorship company management structure. In India, there is only one tier. There are many other requirements in India, which is very different. So we are not going to impose, as an organization, as a rating agency, we are not going to impose a imaginary ethical or moral obligation on the companies. We are going to use a framework and a system which is being driven by the regulators and the Indian system here. So that's how we are going to be different.
Sure. I think there are questions pouring in, but I'm going to limit it to one last question in which I'm going to ask everybody. We will probably reach out these questions subsequently and reach out the answers to everybody who's raised the questions. But I think one last question is probably coming to almost everybody's mind. One is, of course, I'm going to improvise that a bit. I mean, this is relating to how do we kind of actually make sure that we become better credit-worthy ecosystem for attracting FDI by linking it up to the ESG parameters. And what is that connection, and what is that one thing that we need to do in order to make it sustainable, in order to make sure that we are able to attract FDI into India, is one question that is there. And I've kind of I'll just one second. Yeah, this is a question from Ritvik Singh. So I'm going to request all three of you, starting with Shankar very quickly.
Yeah. So to attract investment from abroad, Indian promoters has to understand how international investors think. So why Scandinavian investor is so hung up on ESG is something that probably a promoter from Bombay doesn't understand as yet. So understanding the investors' priorities and and how they can align their own priorities with the investor priorities if they want to attract that fund is something that they have to work on. That's my limited point, but I think Mukund will be a better. He being an investor, he can give the answer better.
Dr. Rajan, with $1 billion fund, what will you look at? How do I create my board to attract that fund from you?
No, I think we've already discussed what it takes to really get a board to embrace this kind of agenda better, how to ensure better disclosure takes place that will automatically result in attracting more funding, including from overseas. But I think the one thing that India does need, and there is a lot of discussion going on currently with the Ministry of Finance, it's a very practical thing, which is India needs a standardized government-mandated green taxonomy. If investors are not clear whether the money they're putting in is going into a project which meets the standards of quote-unquote greenness in markets like Europe and the US, then it's quite possible that it won't come to India, that capital may go to other markets. So since the question is essentially about FDI, I think Europe has perhaps made the most progress towards creating a green taxonomy. We are actually trying to evaluate how usable that is in the Indian context. The big elephant in the room in India is, of course, our heavy reliance on coal in our energy system. And there are efforts to try and see whether we can have a transitional taxonomy which takes you eventually to green. But if we don't crack that, then things like green bonds, green-related FDI, all of that becomes a bit more problematic. So that's one fundamental issue, very practical issue that India has to solve very quickly.
Thank you very much, Dr. Rajan. Dr. Modak?
No, just to add to what Mukund you said, I think one point is that we have to be like, again, Shankar, you talked about, we got to be aware about what are the expectations of some of the international investors. But if you do an analysis, you will find that there are only 3 or 4 driver financing institutions and funds, and everybody mimics and copies and cites references to them. So most of the the private sector funds, you will find that they adopt IFC principles. Or you would find many of the DFIs like the ADB or the World Bank, they influence quite a lot of the large DFIs which are bilateral, also like KFW and so on and so forth. So that's one way, is that you don't have to really run around everywhere, but at least track these 5 or 6 very influencing financing institutions. So that is one part. The second part, we also have to be a bit anticipatory and not just keep reacting to what investors are asking today. For example, if you are sourcing renewable energy funds, it is possible that the funding institutions will ask the borrower to show a very clear plan for the either recycling or disposal of the solar panels after their end of life. Now, this is going to be a reality. This is not right now said by many investors, because if they say that, they know there will be too much competition in the market if somebody is asking for it. But a clever fund may have another sub-fund to fund actually or finance the recycling activity and look at it as an opportunity. And the same thing will go for getting climate vulnerability in the requirements of the borrower's end and setting up an adaptation fund. So you got to be not just reactive and keep watching what outsiders, if I use the word, are asking for, but think creatively and go beyond. And that's the science, that is the sign of a mature organization when they look at ESG. I have seen 90%, 95% organizations are just responding or reactive to ESG impositions. Very few have thought beyond, and in fact, they give it back as a bouncer to the investors. I remember one of the World Bank meetings, I asked the treasury of the World Bank, boss, do you have an investment philosophy for your treasury? And there was a silence.
Yeah.
It's easy for them to preach what should be done by their borrowers, but that doesn't mean that they themselves follow those principles.
Great one, sir.
You got to be smart in talking to these guys. Okay.
Thank you very much, sir. On that note, I think we will conclude this. One other thing, just last one from me, which I wanted to add, was to say that it does make a business sense to have ESG at the center point at the board, because it is simply a good business to do. Thank you very much. Thanks a lot, Mr. Shankar Chakraborty, Dr. Mukund, Rajan, Dr. Prasad, Modak. I never thought this could end, because we could keep on talking on this topic forever. But I'm conscious of the fact that we have to. It's 11:45. My amended KRA is achieved. Thank you very much to all of you.
Thank you. Bye-bye.
Bye-bye. Over to you, Diti madam.
Can I request you to take over for a vote of thanks, please? Shruti, can I request you to put Juhi in limelight? Thank you.
Indeed, after listening to our panelists, we are armed with the strategies to bring ESG to the boardrooms, such as creating a policy framework, such as credit rating policy, measuring ESG performance and the progress, importance of ESG to board, that is mainstreaming ESG into strategy of the company to achieve its vision, aligning boardroom decision to ESG with overall organization, integral commitment through leadership and communication, committee of expertise of sustainability. Thank you all our speakers, Dr. Prasad Modak, Mr. Suhas Tuljapurkar, Dr. Mukund Rajan, and Mr. Shankar Chakraborty for all the valued time. Now I would like to invite my colleague Yash Raj to tell us about the upcoming session of Social Infrastructure Track.